Hey everyone, welcome back to WorkTech. It's George LaRocque, and this is one of my favorite conversations. We've got a recurring guest, Andrew Flowers, the economist from Appcast, and I really enjoy conversations with Andrew. And who better to talk to than an economist right now in such a confusing time for me and everyone I talk to? So, Andrew, welcome.
Hey, George, thank you so much for having me again on WorkTech. It's a pleasure to be here. And just piggyback off of what you said, a quote I really liked from last year goes like this: if you're not confused by the economy, you're not paying attention. And that's from Jason Furman, a professor at Harvard and former economist for President Obama. And so I agree with you completely. It's a confusing time, and I'm trying my best humbly to make sense of it. So glad to be back at WorkTech.
Well, yeah, and thanks for coming and trying to help us make sense of it. As a analyst and advisor in the space, I get asked a lot of questions about the economy or the market, and I don't think any time in my career have I said I'm not an economist as much as I have in the last 12 months. So I've been really thinking about this conversation. So let's start out. I wonder, thinking about what's happening right now. Last year at this time, everybody was talking about recession. Recession's looming, recession's coming, and I want to give you credit. When we spoke maybe 6-7 months ago, that was still the talk track in the market, and you said I don't think we're going to have one, and here's why, and you laid out some good reasons. And but so why didn't it happen, and how do you feel about a recession looking forward?
It's been a pleasant surprise that the U.S. economy has been more resilient than forecasters expected. Yes, I did write as recently as March of this year how while a majority of economists did predict a recession beginning in 2023, around 60% of business economists did. I was in that minority, right? I was in that 40%. That said, it's a close call, right? It's a confusing state of affairs, which we'll walk through in just a moment. But at a really high level, when I am asked why are these numbers coming in stronger than expected, why is a recession maybe off the table at least for this year, the short answer is directly involved with recruiters and TA leaders, HR leaders. And it's this: the strong labor market, the strong job market in the US is fueling strong income gains. And as inflation has come down, it hasn't come at the cost of unemployment. It hasn't triggered a mass increase in layoffs. And so the fact that the job market has been resilient and inflation has come down, it's fueling strong income gains for households. And what are they doing? They're spending that money. And that consumer spending is really steering growth higher than expected in steering the economy away from a recession. There are other tailwinds as well. There's other factors, like, for example, we can get into this. Construction spending on manufacturing facilities has helped to the tune of $100 billion or so this year. More immigration to kind of ease wage growth that was kind of out of control. And so that was good news for inflation when we saw an uptick in immigration. So there are other tailwinds, there are other explanations, but the core explanation is the strong labor market. So let me, if you don't mind, George, could I just share a few data points to kind of walk through that?
Oh yeah, please.
Yeah. Okay. So how about let's start here just with growth, right? And hopefully, your viewers and listeners, even if you can't see this chart, I'll talk you through it. The headline here is that GDP growth has been very respectable. GDP, if you don't know, stands for gross domestic product, the total amount of stuff and services we create as an economy after you adjust for inflation. That number, GDP growth, has been growing around 2% in the first half of this year of 2023. It grew at 2% in the first quarter, grew at 2.1% so far in the second quarter, and in the third quarter, it's tracking even higher. So that's not a recessionary growth rate at all. That's
Right.
2% is basically what you would call trend growth. And that's what this chart here shows. And on the next chart, when you look into the guts of GDP growth in terms of like, okay, what are the components driving this economy at a steady rate of 2%? It's the consumer. And so consumer spending here visually in the light blue and dark blue bars, that's consumption for goods and services, respectively, and how they contribute to GDP growth. And in percentage point terms, you can just visually see that the blue, dark, and light blue bars here are kind of powering consumer spending and lifting GDP growth. Now, last year in 2022, one drag on the economy you see here in the orange was investment in residential structures or real estate. Now, the housing market has been slowing. It's pretty weak, but it's kind of bottomed out. And actually, many forecasters expect the housing to contribute modestly in a positive direction later this year. So again, the top line story here is consumer spending is powering growth away from a recession. But why are consumers spending money? And so on this chart here, this is what I mentioned earlier, the virtuous cycle of a strong labor market feeding through to income gains. And what you see here is real personal disposable income. George, for your listeners, that is income after adjusting for inflation
Okay.
and after adjusting for taxes. Yeah, and it's been growing. You see here on the light blue bars, it's been growing year over year for the past 7 months. So for most of this year, we've seen as inflation's come down, we've seen real income gains for households after taxes increase. And so that's what's powered consumer spending. That's what's powered GDP growth. And we can talk about it in a second, but why are these income gains so strong? Well, part of it's because inflation has fallen, but part of it, the main driver is that the labor market is just so strong.
Yeah. It's fascinating. Is this do you feel like we're out of the woods as you look forward? Because there's still a sentiment of there's still challenge in the market, right? Like whether I look at it from when I zoom out, I see what you're talking about, right? I'm like you're looking at many more metrics than I would, but as I'm looking at the capital flowing into the space, it was an anomaly in 2021 and the first half of 2022, the amount of capital flowing in, but I've called it a hangover or recency bias for folks. They're sitting in 2023 saying, "Oh, the capital markets dried up," and when I zoom out, it's actually the fourth or fifth largest year we've ever had, and we're only 3/4 of the way through it. We're it's not going to be 2021, but it'll probably beat the biggest year before that. So it's interesting, but yet, there's that feeling of how tough it is. The job market is, still relatively, like full employment based on the numbers, but there's so many layoffs and so many folks hurting. So how do you reconcile that? I think that's where some of the confusion comes from,
Yeah, the way I would summarize my explanation is that the fear of a recession is exactly what has prevented a recession. So when we talk about recessions, they come in different varieties. Some are fueled by like a crisis, like a pandemic, right, in
yeah,
2020, or a financial contagion, like in 2008. But often, the saying goes among economists, expansions don't die of old age. They're kind of killed off by higher interest rates. In other words, the Federal Reserve sees the economy grow. It expands until a point where inflation gets kind of too high, and then it starts to jack up interest rates, and it kills off, so to speak, that expansion. It triggers a recession. Well, that's what a lot of people expected over the last year and a half. Why? Well, as we all know, starting in 2021 and through 2022, inflation was out of control, right? We
right,
saw it rise at a rate that was the highest in about 40 years. And so the Fed, starting in the spring of 2022, began to jack up interest rates, right? So
right,
everything from your mortgage rates to car loans, everything started to go up. Now, historically, this is true, and this is why a lot of economists predicted recession. Historically, when interest rates were driven up that fast and that far, a recession ensued. Well, what happened this time was that the Fed telegraphed, the Federal Reserve, in raising interest rates, it telegraphed to the economy, hey, everyone, we got to tap the brakes. We got to ease up. The economy's overheating. That's what's causing the inflation. So we got to ease up on all this spending, all this investment, all this trade. And so we're going to raise interest rates to kind of, take away the punch bowl from the party, so to speak. And when that communication from the Fed happened, everyone kind of cooled their jets for a moment. Who's everyone? Well, businesses and investing, consumers and spending. And we saw growth, which was at a breakneck speed in 2021 and 2022, and hiring, which was just exploding in those years. We saw it all cool off. And that's exactly what averted a recession. Why? Because if you don't mind, actually, we'll come back to this later, but I can show you how inflation has been really trending in a great direction. And part of that is because the growth rate of spending, while still strong, has kind of gone back to trend. The labor market, while still strong, has cooled substantially. And that's contributed to lower wage growth, lower price growth. And that's what has kind of allowed us to say, wow, wait a second, this fabled soft landing that people talk about, of the ability to bring inflation down without triggering a recession, it may actually happen.
Okay. Yeah. And is that what you think is happening right now, or?
Yes, I do think in 2023, in the near term, the momentum of the economy is so strong that I don't see a recession on the near term horizon. Now, that said, 2024 is a different ballgame because first, I don't have the hubris to actually predict a year out. I think I've been burned enough. I've seen economic forecasters kind of get over their skis and try to expect, what's going to be around the corner in 6 quarters. That's really not that accurate, even with the best of models. But let me just show you, in terms of the soft landing, what I think is going to happen with the soft landing. Just to take a step back for your listeners. What is a soft landing? And I have a good chart here to kind of walk folks through. So hopefully everyone can see this visual of a plane landing softly here. And what we mean when we say a soft landing is that there's disinflation without a recession. And the question is it happening now? Well, let's look first at the labor market. So the labor market is very tight. We see here, this chart is showing you labor demand, which is total employment plus job openings. That's around 170 million. Labor supply, which has increased a lot, which we'll talk about later, that's around 167 million. So the fact is the labor market is tight, meaning the demand outstrips the supply by around 3 million. So far, so good, right? We've seen the unemployment rate remain low. We've seen job gains. Here you see the kind of monthly net payroll gains. These are on a kind of glide path downward here. The orange and blue lines are kind of not hitting a negative territory at all. They're kind of just slowly cooling off. But we're still seeing pretty strong payroll net gains of around 220,000 per month. So that's good. We see job gains are good. We see job postings, which are, to use Indeed as one example, they're still 27% above pre-COVID levels. So they've come down a bit for sure, just as the monthly payroll gains have kind of cooled off. Job postings as well have cooled. And again, job seekers still have a favorable market. Right here, you see that we've had 20 consecutive months, George, with the unemployment rate below 4%. And that's closing in on a record, and it could perhaps, in all likelihood, surpass a record that is about 50 years old. So all this is here to say that in terms of the soft landing, definitely the labor market is showing no red blinking signs. It's still green. It's still very tight. It's still very strong. What about inflation, though? Again, this is the real story of a soft landing: is not only can you not trigger a recession, not trigger higher unemployment, but can you bring inflation down? And so one chart I have for you here is just look at this. This is the Consumer Price Index. When we look at core inflation from the CPI, George, it's down to an annual rate of around 3%. And even that here is an overestimate. So let me just explain what I mean here, because some folks may be kind of saying, hold on, what do you mean by core? So core inflation strips out food and energy prices, which are notoriously volatile. You know, they're set on global commodity markets. Actually, the headline inflation rate's even lower right now than the core inflation rate. But so, in other words, I'm being conservative here and showing you the core CPI. That's growing at around 3% at an annual rate. So it's still too high, right? The Fed's target, what it likes to see, if you look prior to the pandemic on this chart, you see typically we want to see inflation around 2.5%, but it's come way down. It's come down from its peaks at 7, 8, 9%
Yeah.
annual rates down to 3%. So inflation's come down. And when I said that that's an overestimate, George, what I meant was there's some components of the consumer price index, notably housing and automobiles, that are acting with a long lag. And so when you look at, say, how new leases are being reset at a lower level, or when you look at wholesale prices for vehicles that will eventually trickle down into kind of dealership prices, what if that shows you this super core inflation measure, which is kind of really a way to track the labor market? It's cooling, it's slowing dramatically. So all this, George, is to say that it seems like inflation is on a great trajectory. The Fed is happy. It is probably in all likelihood going to not raise interest rates in September. So in September 22nd or thereabouts, later in the month of September, the Fed is having a very important meeting where uh, it's divided whether it should keep raising interest rates. It's raised them over 5 percentage points in the last, less than a year and a half. And I think in all likelihood it's done. I think the Fed has seen, not to wave the mission accomplished flag, but it's seen inflation come down. It's seen the labor market remain strong. And so to answer your original question, George, yeah, I see for 2023 and early 2024, I see a soft landing for the U.S. economy.
Okay. Okay. And much of what you've talked about today, you've really done a great job, sort of helping us understand how the labor market has really been a strategic asset for the Fed. And I don't know if anybody expected that when they started raising rates. But do you feel, I talk a lot about the macro trends that we've in our world of recruitment, talent acquisition, talent management, workforce. For a long time, we've been looking at skills gaps. Now we're looking at, there's a debate about the shrinking workforce, and you've probably seen the Lancet study about the ratio of, working age population globally compared to retired or out of the workforce, how that's dropped massively, and it's not predicted to turn. And this takes in mortality rates and birth rates and so forth. Is that all feeding into this sort of like it finally, I go back, what was it, like 2000 or 1998, 99, when the War for Talent, hate the name of the book, but the War for Talent came out and talked about the skills issues. I feel like we've been aware of these issues but this really brought it home in this cycle. Is that what's happening? These macro trends are really more tangible. We can see it in the economic numbers.
Yeah, there are really three key trends, I think, in terms of like decades-long trends that are part of the explanation for why this labor market is kind of surprisingly tough for recruiters, for TA leaders, why talent is so scarce. And so the first one, what I would call the great people shortage, is what you just touched on, which is that we're seeing several decades of very low fertility rates catch up to advanced economies across the globe. So as birth rates have fallen and population growth has slowed, and immigration, which is very politically contentious, is uncertain, you see exactly what you just said, these age dependency ratios, where with the baby boomer generation, for example, retiring, there's just an inherent structural scarcity of talent, right? So that great people shortage, the demographic effects, it sounds like it's decades away, but it's here and now, and it's going to get worse. So that's definitely a huge part of this kind of talent scarcity. And there's one simple way you can think about this is like, well, how many unemployed active job seekers, when you take that compared to job openings? In other words, the ratio of how many open jobs are there for unemployed job seekers, that's very, very high. It's at 1.5, meaning that, like, historically, say 10, 20 years ago, George, there would be 2 or 3 unemployed workers for every one job opening. Now there's 1.5.
Yeah.
There's 3 job openings for every 2 job seekers, roughly. So that 3-to-2 ratio, or 1.5. So that's the great people shortage. That's definitely a big trend, right? The second big structural trend that I think is really important, that's more present, it really is a COVID phenomenon, is what I would call labor hoarding. And labor hoarding is the phenomenon where companies are not laying off workers, even if revenues are declining. Why? Because recruiting costs are so exorbitant. In other words, companies that kind of laid off workers and then as they rehired coming out of the COVID pandemic, a lot of businesses, and maybe your listeners experienced this. In 2021 and 2022, there was this explosion in the labor market and hiring. And a lot of that was driven by the desperation for companies to staff up again. And now that kind of GDP growth perhaps is going to slow and higher interest rates perhaps may lead to kind of slower growth, you would think, well, historically, that's going to trigger layoffs, right? And so far, no. And actually, I have a great slide on this, but the reason why layoffs haven't risen, except for maybe the tech sector is the one exception. The reason layoffs haven't risen is because of labor hoarding, that companies are saying, you know what, it's so costly. If the market turns around and we have to rehire these workers, it's just not going to happen. And so we'll eat the cost. We'll keep our payrolls as they are. We won't let people go, even if our business is turning south a bit. So that's part of the reason that we see a labor hoarding phenomenon happening. So the third reason, though, and this is something we can touch on later, but I think is transforming recruiting, is artificial intelligence and Chat GPT. That's a kind of decades ahead or years ahead effect, but I think that's also reshaping recruiting a lot.
So do you see, let me back up. When you're talking about, these more macro trends that are just going to get worse around, available talent in the workplace, and thinking about growth normally requiring more talent, is that, is that the solution? Is it artificial intelligence and automation? Do you see that becoming one of the things that helps us from an economic perspective, job market perspective?
I think that's definitely part of the solution, is better innovation, higher productivity, right?
Yeah.
One way to continue to grow your business when talent becomes scarcer and scarcer is to have higher productivity workers. And one way to do that is to, rely on the latest and greatest innovations, such as, generative AI and other forms of automation. If you're in a production setting, robotics are really advancing. That's definitely part of the solution. Two other ideas that I think are really important are, one, worker training, both in terms of the educational system, but also on the job training, and making the highest and best use of existing workforce. Even though these workforces are shrinking, investing more in skills, not waiting on some government agency to do it for you, but being proactive as an employer. That's a core component in addition to AI. And then the third thing, George, I have to mention is immigration. I think a big story here when we talk about aging societies is that's for advanced economies in North America, in Europe, and East Asia. But there are other parts of the globe that aren't seeing shrinking workforces, like South Asia, like Africa. And so, to just give you one example, I think the best reason that the U.S. economy has outperformed its peers over the last year or so, like if you want to compare us to Germany or the UK, in terms of GDP growth, in terms of inflation, in terms of the labor market, you pick the indicator, George. It doesn't matter. The U.S. economy has done better. And I think one big explanation for that, I'm going to show you a chart right now, is immigration. Immigration, when you think of it as a global perspective, there's a lot of talent in the world. So here I'm showing you how, the share of the US workforce that's foreign born recently hit a high that goes back to at least the 1970s. So this data here I'm showing you only goes back to 2005, but you see there was a big decline during the COVID years of 2020 and 2021. But now we have a big spike in 2022 where 18% of the US workforce is foreign born. That's been a huge tailwind. It's been a huge boost for the US labor market. Why? Well, as you see in this chart, immigrants are just simply put more likely to be employed, right? The foreign born labor force participation rate compared to native born workers, or the foreign born, here I'm showing you the employment to population ratio, just the sheer percentage of people who actually have a job. It's much higher. It's at 65% for foreign born workers, and it's below 60% for native born workers. So all this to say, George, AI is a big part of the solution. Worker retraining and immigration are too. The thing I want to circle back to AI, all the buzz about ChatGPT, about generative AI, it's great, it's cool, right? It's a really advanced chatbot. That's awesome. I just want to caution folks that this is not an overnight phenomenon. In the history of economics, I want to give a shout out to Julius Probst, who's one of my colleagues. He's an economist based in London for Appcast, and he has a PhD in economic history. And he wrote a great piece for Recruitonomics, the site that I run, about the history of innovation, like transformative innovations. So if you want to think of generative AI and ChatGPT as a transformative innovation, like the internet, or like the automobile, or like electricity, he went back in time and he looks at databases of 200, 300 years, where you're looking at labor productivity, you're looking at growth, GDP growth, and what he found, and this is just well known among economic historians, is that these transformative innovations, they take years to decades to actually show up in the economic statistics. So all this to say, George, in summary, generative AI is really cool, but it's not going to overnight be like a light switch and transform recruiting, transform TA in 2023. It's gonna slowly and steadily at first, and then quicker and quicker make changes. It's going to start transforming our industry. I don't want to kind of pour cold water on it. I think it's important, but it's going to take years, not months.
Yeah. Oh yeah. Yeah. The interesting thing about it is from a tech perspective, how rapid the adoption has been, and that overnight millions of users, and it continues to just while it's flattened out, it continues to it is the zeitgeist in the tech world at this point. But the other thing that is interesting is how it has also freed up the conversation about other types of AI and automation. So, prior to November of 2022, there was AI in our market. There was AI. You're from Appcast. There's AI in Appcast, but But you didn't talk about the AI. You talked about, with buyers and customers, you talked about the outcomes, because AI was it felt like a very complicated or complex black box. And so it was about the outcome. Then ChatGPT came out, and suddenly every leader in every discipline is wondering, how can we leverage AI? How can we leverage this? And the answer isn't just generative AI. So it's the impact that it's had. I don't disagree with the timing that you framed at all. I think, we usually, like, from a tech adoption perspective, if I look at our WorkTech market, it takes about 10 years before you really know how something's going to get really adopted, used, what benefit it's really going to deliver, 7 to 10 years. So this, even accelerated, 5 to 7 years before we really understand it. So I agree with you wholeheartedly. And this has been fascinating. I don't know if there's anything that I didn't ask you about today. I know we've sort of hit time, but if there's anything you've covered so much ground, anything that you think would be beneficial for folks to hear about or think about as they're preparing for 2024, things they might be watching, or things I didn't ask about that I should have.
Well, actually, speaking of 2024, we all know that that's an election year. I think I'll end with one note, which is not exactly news to a lot of folks, but the Biden administration has passed a lot of fiscal stimulus to try to boost the economy. And I think that's something that the president's going to try to run on next year for the election. And one way that's manifested itself in terms of the macroeconomy and how that trickles down to recruiting and for TA leaders is the raft of bills passed in 2022 last year. So
Okay.
starting with the Bipartisan Infrastructure Act, but also the CHIPS Act, which was to kind of provide subsidies for semiconductor facilities in that industry in the U.S.
Right.
And then to roads and bridges with the infrastructure bill, kind of semiconductor fab facilities with the CHIPS Act, and then of course the Inflation Reduction Act with a lot of tax credits for green technology and so forth. The only thing I want to end with here, George, is to say one tailwind I briefly mentioned, but I just want to show you the chart because when you look at this, you're like, whoa, because it's you don't see many charts like this that are kind of parabolic. And what I'm showing you here is in billions of dollars, the amount of money spent on constructing, in terms of construction spending on factories, essentially, right? These are manufacturing facilities, and it's exploded. It's been rip roaring. It's a boom that I think, when you look at it, 2 years ago, this spending on factories was around 80, 90 billion at an annual rate. 1 year ago, it was a little higher, maybe 100 billion at an annual rate.
Yeah.
Look at this. It's at almost 200 billion. It's doubled in a year, George. And so I'm going to take this chart down and I'm going to conclude by saying $1 billion does not move the needle on the economy. $10 billion doesn't move the needle on the economy. But $100 billion in the course of 1 year, regardless of your politics, I'm just looking at the data. I'm just trying to make sense of why, a recession has been avoided. $100 billion can put a few tenths of a percentage point to the U.S. GDP growth.
Yep.
And so I think that's something that is going to be front and center in our politics next year is the economy, debates about, well, unemployment is good, but inflation is bad. And that's going to kind of continue to be with us if I had to predict how it would affect our politics. But in terms of how it affects recruiting, this stronger economy, particularly in construction and manufacturing, is quite impressive.
Well, just the growth in the last year, those types of projects tend not to be, it's not like building a house, right? These are bigger, longer term projects. And, what they're going to fill those manufacturing facilities with two things: people and tech. That's what's going in those, in those facilities. So it kind of, I can see where that's going. Well, this was fantastic, Andrew. You never disappoint, giving me things to think about and helping, really understand what's happening. I hope you'll come back, in a few months and we can check in. Yeah, that'd be great. And thank you so much. Thanks for your time and all of your insight.
It's my pleasure, George. Thank you so much for having me and for the whole WorkTech community. It's always fun to be here. So thanks.
Great. And thanks everybody for watching and listening. And until next time, thanks all.